Now it's time to get started with the valuation section of this model. Let's open up the valuation area. We're going to start by pulling forward earnings before tax, then calculate a net operating loss schedule. From there, we'll build up unlevered free cash flow, and finally, calculate the net present value of the business. Let's also open up the income statement and the assumptions area. We're going to be referring up to those. So let's start by linking our earnings before tax. This is here for easy reference. Our opening balance is going to be our typical corkscrew function where this year's opening is equal to last year's closing. Now we're going to pull forward the current loss in a year, but we only want to pull it forward if there's actually a loss. In order to do that, we're going to set this equal to if the current year's earnings before tax is less than 0, then return that number in positive form. So I'll use the ABS function here. Otherwise, return 0 since there's no loss. Now I'm going to calculate the subtotal, which is the opening balance plus the loss that's added to the balance. To calculate the loss that's used in a year, we're going to use a combination of an if function and the minimum function. I'm going to say that if the earnings before tax in the year is greater than 0, meaning there's a potential tax liability, then I'm going to take the minimum of the balance that's left in our tax loss carry forward or the earnings before tax in that year. Close bracket. Otherwise, 0 tax loss is used in the year. Close bracket. Now we're going to calculate the closing balance, which is equal to the subtotal minus any tax loss that's used in the year. I can select this entire section and the area to the right and press Ctrl R. What you'll see here is that we start with a balance of 0. We have a loss in year 1, so we add it to our balance. We don't have any tax burden, so we don't draw on it. This feeds in the corkscrew fashion, adding another loss the next year and not using any of it. Then finally in 2018 things flip. We now have a potential tax liability. So because we had positive earnings before tax, we don't add a loss. We do, however, deduct our income by the full amount that we don't have to pay any tax because we have this pool available to us. We continue to drain the pool until it finally runs out in 2020. And at the end of this period, our tax loss carry forward no longer exists and we pay taxes in a normal way on income. Please take a moment to go through this again on your own, as some of these functions can be a little bit complicated. Once you have them set up, I hope you're able to use this in all your models going forward.